acknowledge the traditional owners of the land that I'm speaking from today, and that's the Gubbi Gubbi people. And I'd like to pay my respects to elders past and present and future. Wilson Asset Management, we're a fund manager focusing on making a difference for our shareholders, and we'll talk about listed investment companies in detail a little later. Two listed investment companies that we were involved in setting up, which we're very proud of, is the two future generation entities, and that's a way of investing with the smartest fund managers around, and that's a group of boutique fund managers, and at the same time giving back. Their codes are FGX and FGG, and you can look at them at your leisure. I'd also like to, just in terms of starting off, if you can read that disclaimer, in terms, it's basically saying that the advice that we give you is general advice, not specific advice. In terms of Wilson Asset Management, I set the business up about 25 years ago. What we'll be going through today, we'll talk a little bit about Wilson Asset Management. We'll talk about the benefits of listed investment companies. I'll talk, it is a really difficult time in terms of the market volatility, and I'll go through in detail, what you should do in these difficult times. And what I'd like to also talk a little bit about is our shareholder advocacy, and particularly retail investors. We have 130,000 retail investors invested in our 8 listed investment companies, and we believe it's very important to stand up for them. And at the moment, there's some various things happening, and I see the ASA, and congratulations, standing up and having a strong voice, as they're very concerned about what could or is happening by the current government about franking credits. And then we'll open it up for questions and answers. And Zoe, who works in our communications team, she'll be, please provide your questions at any point in time, and we'll be answering them when we get to Q&A at the end of the session. In terms of Wilson Asset Management, set up 25 years ago, the whole focus was to make a difference, make a difference for our investors and our shareholders, to make a difference for the community we operate in. And on the screen, you can see in front of you is the team we've got, a great combination of very smart, capable people. In respects to making a difference, we are a member of Pledge 1%. I mentioned earlier about the future generation investment companies, and we also have various strategies for our current shareholders, our current employees, to give back as well. And because we're part of the community, we understand that it's very important to support the community you operate in. The future generation entities, which I talked about earlier, they're 2 listed investment companies, and they're managed by a group of boutique fund managers, who manage the capital. FGX, Future Generation Australia, gives you exposure to Australian boutique investment managers. FGG gives you exposure to global investment managers, and all those boutique investment managers, they're the smartest that the investment committees can find, and the boards around, and they all do that pro bono, which is incredible, and that allows both those entities to support children at risk and youth mental health, and they're incredibly worthy causes. In terms of just talking about the listed investment structure and the superiority of it, probably if we go back 30 or 35 years, before I set up Wilson Asset Management, I started off in the early 80s as a fund manager at Scottish Amicable, and then I went from being a fund manager to work in the broking area as an analyst, as an institutional sales, and then fortunately I was able to work in London for a period of time and New York. And I remember about 35 years ago reading a bit of research that Morgan Stanley in the US had written, and it looked at closed-end funds versus the mutual funds in the US, which is the same as the open-ended funds in Australia. And what it showed is those closed-end pools of capital, or listed investment companies over here, and they call them closed-end funds over there, that were managed by the managers, had outperformed the open-ended pool of capital, or the normal funds, by about 2 to 2.5% per annum. And to me, that is over a long period of time, and we all have paid attention to Warren Buffett and understand the sort of the nine wonder of the world. The impact of compounding. If you're compounding at 2 to 2.5% higher than everyone else over a 50-year period, that's what the research was done over. You really do get some exceptional returns. And I was sort of incredibly curious. Why do these closed-end pools of capital, listed investment companies or closed-end funds in the US perform so well? And the reason they do, it's because the average shareholder, they tend to buy at the top of the market, when everything's going well, and they tend to sell at the bottom of the market, when everything isn't going that well. And so the performance that the average investor gets is usually half what the market performance is. And what you find with open-ended pools of capital, or just normal managed funds, then when everything's going well, all the money flows in. So the fund manager is then buying expensive stocks, and when everything's going, and he's investing in sort of towards the top of the market, and when everything's going bad, like say the GFC, then the fund manager's selling. Everyone wants their money back, they want their cash back, and the fund manager's selling at the bottom of the market. But with a listed investment company, it's a closed-end pool of capital. So you as a fund manager, that capital doesn't change. So the share price might go up and down, but that pool of capital stays the same. So that is incredibly important in the listed investment company structure. Also, what it allows you to do as a fund manager is you have confidence in the pool of capital you're managing. So you know that you're not going to have a whole lot of redemptions short term and be a forced seller. So you can make medium long-term investment decisions. So to me, they are two very crucial parts. The third part is they're listed on the stock exchange, so it's very easy to buy or sell in terms of liquidity. Also, because they're listed on the stock exchange, and also they have boards, which are responsible for shareholders. There's a direct, if you're a shareholder that's disappointed with something, then you can communicate directly with them. I know one of our shareholders rang me a little while ago and was trying to communicate with his managed fund, and he'd sent them a number of emails, and he'd sent us one email and said he'd like to speak to me. So I gave him a call, and he said, I've been incredibly frustrated with communicating with the managed fund because I just haven't been able to get access. And so, that is another positive for the structure. One of the other positives is because it's a company structure, you pay tax in the company structure, and then you can pay fully franked dividends to shareholders. Now, most managed funds are trust structures, so effectively they pay out whatever profit they make in that year. But with a listed investment company, say it's a dollar is the asset value. So it goes up from $1 to $1.40. It's in a strong bull market, so that you've got a 40-cent profit. If it was in a trust structure and that was realised, that would be paid out to you immediately. In a listed investment company structure, that 40 cents profit can be paid to you over time. And as the company pays tax, it can pay to you as a growing stream of fully franked dividends. So, to me, that's a great attribute. Particularly, I've had people that have been in managed funds and that have come over to listed investment companies, and the reason why they do that is because they like Well, I remember one person put quite a bit of money in our listed investment companies and was with another fund manager in their managed fund. And what he said, look, I want to know about consistency of dividends, and I just don't want to be, getting complex, distributions on an annual basis, and when I really don't know what size or magnitude they'll be. And he said, because I want to be able to do my tax very quickly, and then I want to spend the rest of the year fishing. And to me, that's another great attribute of listed investment companies, and they can provide a growing stream of fully franked dividends to shareholders. And then probably the sixth attribute, which is on this slide, is the fact that they can trade it at a premium or discount. Now, I see that as one of as sort of close to the holy grail of listed investment companies, besides the benefit of the closed-end structure. And that is because you can buy $1 of assets for 80 cents. So to me, when I was setting up WAM Capital, the first listed investment company that we managed, I just thought it was incredible. I'm investing, we're creating a structure that should outperform managed funds because it isn't impacted on money flowing in and money flowing out. And also that I'm in a situation where if the $1 of assets is trading at 80 cents, then I can buy it at a 20% discount. So if it goes back to $1, you actually make 25% on your money. So to me, that's one of the great things. And also listed investment companies can trade at a premium. And then you've got to assess whether the premium's too high or etc. But to me, there are other great attributes which you don't get in ETFs. So to me, a listed investment company is giving you a professional fund manager, managing your money on your behalf. You're also in an opportunity, you have an opportunity which is better than an ETF, where you can actually potentially buy the $1 of assets, not at $1, but cheaply. And if you're correct and the manager performs and the share price moves back from 80 cents to $1, or may even go to a premium, $1.10 or $1.20. And some of the larger listed investment companies, the AFICs, the Argos, the WAM Capital, the three largest, you'll see all three of them are trading at premiums to NTA at the moment. So it's just and there are times where they trade at discount. So to me, it's just another great attribute that if you want someone to professionally manage your money and you want to have some input and add some value to the investment decision, that's a really good, a great asset that listed investment companies have. In terms of the listed investment companies that we manage, look, there they are. And you can see, some trade at premiums and some trade at discounts. Our goal is to have them all trading at NTA, if not a premium. You see, look, some of them are trading at very large premiums, like WAM Research. I think on the latest numbers, about 40% plus premium. WAM Capital, our largest, at a 20% plus premium. But some of the others, the newer listed investment companies, and to me, it takes a little bit of time for the share registers to consolidate and to tighten up. And that tends to be the newer listed investment companies. The newest one that we've taken over, WAM Alternate Assets, trading at about a 15% discount. And then WAM Global is trading at a discount, and WAM Strategic is probably our newest, followed by WAM Alternate Assets and WAM Global. And over time, those discounts will narrow. And when I floated WAM Capital, back 23 odd years ago, for the first couple of years, even though the performance was exceptional, and I think the first year, we really had two fantastic, vintage years to start. And I think we might have paid on $1 issue price, we might have paid 12 cents fully franked the first year and 14 cents fully franked the second year. But we just had some really exceptional period. that we actually, but even then we were trading at a 20% discount. It took us about 3 years to get it to trade at a premium or NTA, and then for a reasonable period of time, it's actually traded at a premium. So to me, it takes a little bit of time to do that, and there's a strategy around that which I'll talk to you about now. In terms of when you're assessing a listed investment company, to me the most important thing is, as a manager, you've got to assess the performance. Do you want to give money to this fund manager? To me, when we buy shares in a company, we really look at management. We think it's very important, because when you buy a share in a company, you become a part owner of that business. So you are trusting. You need to really trust the management of that company. And to me, it's similar to fund managers. If you're giving a fund manager money to, you're investing in their listed investment company or listed investment trust or even their managed fund, then you need to really trust that manager that's going to perform for you. So to me, you've got to look at performance. I like looking at performance before all fees, because I look at it against the all odds, so I can make an assessment. I know, we charge a 1% management fee and a 20% performance fee, because we like to get paid for outperforming. And that's our real focus. So, we're 20 times more focused on outperforming than just performing on your behalf. And we only get that performance fee if we outperform the market. So to me, that's very important. But I like, because everyone has different fee structures, I like looking at managers, seeing how they're performing against the market or the index that they're benchmarking themselves against. In terms of listed investment companies, that I mentioned earlier about the fact that they can provide a growing stream of fully franked dividends, and what's important, you need to find out what's in listed investment companies' profit reserves. So how much profit they have stored away that they can give out to shareholders over time, and also it's important to look at how much franking they have and their ability to pay out fully franked dividends. And I'll talk about franking in a little bit more detail a little later. It's and the very disturbing position we're in at the moment with what the Labor government is proposing. The third thing is probably important for all companies. It's all listed companies, not just listed investment companies. Probably all people that manage companies as well. Is you've got to treat your employees with respect and treat your shareholders with respect. And we understand that with our listed investment companies, the shareholders own the company. So we only do what we're really passionate about because shareholders allow us to do it on their behalf. So we totally understand that. Unfortunately, in this day and age, you do find boards of companies that don't understand that they're only there because of the shareholders' wishes. And that's one of the great things about the Australian Shareholders Association now, is you do an incredible job of keeping companies and board holding them to account. And to me, it's brilliant, the work you guys do, and like we try to be a voice to that as well. In terms of engagement, to me, it's you really, and this is probably the piece of the puzzle that most companies could miss, but also most listed investment companies should need to focus on, and that's engagement with their shareholders. And why does when a list, someone who runs a listed investment company comes and sees me and says, "Look, Geoff, I noticed WAM Capital's, what your largest listed investment company, it's trading at a 20% premium. How is that possible?" And I say, look, it's actually quite a simple exercise, because as Buffett talks about, the market is a weighing machine. And it's really driven on economics. I remember first year economics at university, they show you the little graph, the supply and demand. If there's enough demand, and if supply and demand are in equilibrium, then then you have, if they're balanced, then you're in equilibrium. And that means effectively with a listed investment company, if there's enough buying and an equal amount of selling, then the share price will reflect the net tangible assets. As your share register tightens up and people sort of understand what you do, and you've engaged with your shareholders and they're happy with what you do, and then if more people want to come and get exposure to that company, then they have to pay a premium to the NTA. And that's what's happened with a number of ours. And it's really tightening up those share registers, engaging with your shareholders, having a detailed communication strategy where shareholders fully understand what you do. You're engaged with the shareholders, and they are very happy, remaining as shareholders. Then and then also you've got to be communicating and marketing, and then when other buyers come in, then they need to pay NTA, if not a premium, and then some pay a high premium, which I mentioned. One of our other listed investment companies, WAM Research, is trading at quite a high premium to NTA. And the funny thing is with WAM Research, that was the one that probably took us the longest time to get it to trade at NTA, and now it's hot. Now it's trading at the highest premium. And it's probably there's it's interesting, that fact. And I think the reason why it took us so long to get it to trade at NTA has resulted in it trading at probably the highest premium of all our listed investment companies. And that's because we spent a lot of time communicating with our shareholders, making them, allowing them to understand fully, what we're doing. And then they were very happy when they fully understood it. And so none of those shareholders wanted to sell at NTA. They didn't even want to sell at a 10% premium, a 20% premium. And now it's trading at 40% premium. So they're the important things. Like in terms of where we are at the moment, it is a volatile market, and things are difficult. What we've learned, and there's a couple of things I just like to address here, is it's very important to look through the cycle. If you were, someone asked me yesterday, I've got some money, what should I be doing with the market? And I said, the tough thing is about market timing. It's very difficult. It's very difficult to pick the top of markets, and it's very difficult to pick the bottom of the markets. What you tend to get a better feel on is when things are overextended on the upside and when things are probably a little bit depressed on the downside. So you really want to be trying to buy into those, into the tougher periods, and be selling into the periods where everyone thinks the market will keep going up forever. And also it's worthwhile to remember that I was Katrina, who's one of our lead portfolio manages WAM Global. She was saying more recently she's just finishing off this book. She's based in New York. And in there, it looks at the Dow, how it's performed over the last 20 years. And I think it was close to about an 8% performance over that period. That's per annum, compounded over that period of time. And in there, they said, if you missed the best performing day of the market each year, so it's 20 days, but the best performing day each year for the 20 years, the performance you would have got if you were invested in that market, if you just didn't have your money in for those 20 days, then you would have got effectively no performance. So the performance over that period of time was zero, where the market was pretty close to an 8% performance. So that's the hard part about trying to market time. How do I feel at the moment? I still feel bearish. I actually think a lot of the excesses that have been in the market, they haven't been cleaned out. And they will be. So I'm a little bit more. I'm still on the bearish side. Another thing is, which is important, just talking about bearish, is to understand bear markets. And how do you position yourself in bear markets, and to understand that bear markets don't last forever, and what follows a bear market is a bull market. So to me, bear markets tend to run for a year and a half, and they tend to be less, which is a lot shorter than bull markets. So that's important. In terms of investing, the tough thing about investing is you need to work against your emotions. So at the moment, say if you're really bearish and scared, then maybe then maybe it's time to be putting some money into the market. When you're investing, again, never fall in love with a stock. We've probably all heard that a number of times. And one of the summary is the great thing about equities is they do perform over time. Every time, say you're driving somewhere and you see an area of Sydney or Melbourne or whichever, well, anywhere, globally, and you see a property there and you think, look, this is gentrifying. Maybe I should buy a property and rent it out and gear up and see what I can do and make some money there. I remind myself, the fantastic thing about when you buy an equity is you are becoming a part owner of that company, and you are relying on the management of that company to perform for you. There's no calls from the real estate agent, or no problem with the tenant, no problem with the property, etc., etc. So that's one of the things I do really love about equities. Properties, great investments, and performs over time, similar to equities. But that's one of the great things I do love about equities. In terms of advocacy for retail investors, from our perspective, that is incredibly important. And what I might do now is I just wanted to, we had the budget. In the budget on Tuesday night, the Labor government announced measures designed to change and undermine the Australian franking system. You saw today, there's quotes from your CEO, the ASA, just talking about that and myself. And I'd just like to read you a few comments that I've jotted down, and I'm going to we'll send these out to the various news agencies because I think it's exceptionally important. From our perspective, the government has broken an election promise and is on the same path that it was when it was in opposition in 2019. Only this time they're trying to disguise the attack on the franking credits by limiting a company's ability to effectively manage its capital on all shareholders' behalf, where previously it was the people receiving the fully franked dividends. The plan was to stop. This is now trying to stop the companies. It looks like the Albanese, Anthony Albanese and Jim Chalmers are introducing or trying to introduce the retirement tax 2.0. Which will have a major impact on mum and dad investors and low income earners, because they are the people that benefit from fully franked dividends. If your tax rate is less than 30%, then obviously you benefit. If you're paying tax at higher than fully franked than 30%, then obviously fully franked dividends aren't a benefit for you. The proposal in the budget looks to limit the distribution of franking to shareholders where companies are returning capital to their shareholders. Now, off-market buybacks historically have provided investors with an easy way to sell their shares and funding their living expenses, our self-funded retirees. Tuesday's announcement follows a recent draft legislation, and I know it's still under review, to stop companies distributing fully franked dividends which are associated with capital raisings. And we put in submissions, and I know you have, and we're very distressed and disturbed about that. This new change will also have a significant distorting effect on the capital formation in Australia at an uncertain time when stability is paramount. We're concerned this is the first stage of the government chipping away at the franking system introduced by Paul Keating to ensure Australian taxpayers do not pay double taxation on dividends. And these are I've got some quotes from Paul Keating. I was up early this morning reading some of his writings back in the 10 years or so ago. And Paul Keating said, people should understand that the Australian taxpayer, understand that for Australian taxpayers, the company tax is broadly a withholding tax. The government collects it at the 30% rate on company income and temporarily holds on to it before returning it to shareholders a year later or a year plus later in the form of an imputation credit. In other words, when a company issues its dividends on a fully franked basis, it hands back the company tax paid earlier and staples it to the dividend. Mr. Keating also noted dividend imputation revolutionises capital formation in Australia, or revolutionised capital formation in Australia. And I totally agree. The cost of capital in Australia is seemingly less than globally. And why did Australia do so well during the GFC? And why will Australia do so well now? Is because normally companies' debt is cheaper than equity. And you'll see in the US and in Europe, companies, they don't have the franking system, so they go and gear up. When things go bad, they go bad. And that's why Australia did so well during the GFC and will do really well now. Keating also, and the Treasury, and this is an interesting comment, this is from Paul Keating. He said the Treasury was uncomfortable with it, and that's with the franking system, because of its cost to revenue. And about every 7 years, Treasury promotes a debate to remove it. And he went on to say that superannuation is about de-risking the future. In the system I set up, this is Keating's comments, people are encouraged to salary sacrifice in later life when mortgages have been paid off and they had discretionary income. And this is still from Keating. While the government and the Treasury would see, and that there's various changes, would see this as a cost to the budget in revenue foregone due to reduced tax revenue today, these changes would provide the government with certainty in the latter years by reducing its future funding obligations. This was one of the original intentions when the foundation for the current superannuation system were laid. He commented. It has become apparent the current Australian government does not understand the importance of the franking system in Australia, as it is the low-income earners, the self-managed super funds, the retirees that are impacted. These retirees have planned their retirement using fully franked dividends as an income stream. Now, back in 2019, the stories that we got and we read, brought me to tears. The impact that was going to have on people's lives was appalling. But unfortunately, I can't believe they're trying to do it again. We understand the impact these changes will have on all ASA members. We do. And we stand side by side with you. And we will fight with you for this illogical proposed changes by the Albanese government. We will stand side by side with you for those changes to be reversed. So that's to me, that's important. And we will make sure we're committing significant resources to this fight. From my perspective, the fight has only just begun. In terms of the group, engaging with shareholders, which I mentioned is incredibly important, and that's some pictures of some of our team. Obviously we engage with the community we operate in. That's the financial planners, the wealth managers, etc. So let's just give you a little bit of an idea there. And we've got a poll we'd like to get a little bit of feedback from you. If you could please provide your answers to the poll questions on your screen. You'll see there, I assume you see the poll questions. The first one is why do you invest? And we're talking about dividends, capital preservation. And unfortunately, we didn't have time to change the questions, for what's just occurred, since the budget. So we might have swung another question in there for you. The second question is, where do you get most of your investment news? And just, for us to get a bit of an idea. And the third question is, we've got 130,000 shareholders. We've got 80,000 of them have signed up, and interested parties have signed up to our newsletter. Just go to the Wilson Asset. It's wilsonassetmanagement.com.au, the website. We'd love you to. You can just say yes there if you'd like to sign up to the newsletter, and we'll send it to you. And we'll continue to. This franking campaign for us is we're dug in for the long term, and we will keep fighting for what we believe is equitable, logical, and right. So if you can do those polls, and then what I might do is, I might pass over to Zoe, who will be moderating or asking me the questions. So we've got a good 20 minutes left. Please, any questions you have, please put them up in the question box.
Thanks, Geoff, and thanks to everyone who's joined us today. The first question that we have is coming from JR, and it's around dividends. He says, regarding the dividend smoothing, how can we see what is being held in reserve? And what are the disadvantages of LICs that we should be aware of?
Yeah, and I'll go from the disadvantages initially. What I think is one of the great benefits of LICs is they trade at discounts and premiums, and obviously one of the things that one of the negatives about listed investment companies is with an ETF or a managed fund, you go in there at NTA. So you get the and you come out at NTA. There might be a margin or a cost, but with a listed investment company, you're buying the share price, which is sort of underpinned by the NTA. So that share price isn't necessarily the NTA. So when you're doing your research, it's very important to understand where the NTA is. And I always like buying. I like buying $1 for 80 cents. So I like buying $1 of assets and with a share price of 80 cents. So I'm buying a 20% discount to NTA. So the negative about listed investment companies is the share price might not reflect the NTA. It might, you might buy a share price at a premium, which some of ours are, and then they might go to a discount. So then you get a multiplier affect the negative, and the negative it goes from a premium to discount. If you bought it at a discount and it goes to a premium, obviously you get the market performance plus a multiplier to the positive. So that's that one. In terms of when you're doing your research on listed investment companies, and that's why I love listed investment companies. Like anyone, if you don't want to spend all your time investing in the market, the great thing is, like, if you just want market exposure, then buy ETFs. But if you want to do a bit of research, then listed investment companies, you can do a bit of research. So you can work out what the NTA is. You can see where the share price is. You can see if you can buy them cheaply. So you can add some value. And also you can work out, do you think this manager is committed and he will get the share price to trade at NTA or a premium one day? So to me, they're all important decisions you should make. And also in terms of in terms of the first part of the question, what was the first part of the question, Zoe?
Just first part of the question is to explain the profits reserve.
It was understanding the profit reserve is, we actually announce it on our monthly NTA. So to me, it's on the 14th of each month, we announce the NTAs for all our listed investment companies. So people can see it there. And as it changes, if you wanted, if companies don't announce it, then you can go to their look at their balance sheet, and it'll be you look at the equity, total shareholders funds, and there'll be retained profit or retained losses, and they could have a profit reserve as well. Some companies don't split it out as a profit reserve. We do, and so then it will just be in retained earnings. Now, the risk, if it's just in retained earnings and not put in a reserve, if the company loses money that year, then if you're holding it's just an accounting. It's just accounting. If you're holding assets in a profit reserve, then if you're holding it if you're holding your profit in the earnings, in retained earnings, and not putting it in a profit reserve, then there is risk that if there's a loss, that it'll get wiped out.
Thanks, Geoff. This next one's from Anne, and she says she realizes you don't have a crystal ball, but she's wondering, post-budget, do you have a view about wealth taxes that Labor might be considering? She thought the rhetoric was softening up for a bombshell at the next budget in May.
Yeah, fair call. I suppose the reason why I'm incredibly disappointed with the performance of the government, as they were clearly communicated to by all Australians back in 2019, to leave franking alone, and they really, unfortunately, they didn't hear that, and it'll be interesting. My belief is they're honeymoon, and like someone I was talking to yesterday said, look, if there was an election short term, particularly electricity price going up, a lot of things they promised, breaking the promise about franking, they were saying they thought the Liberals would win. Like, that surprised me, but that was a comment. And broadly, what they're doing is by the things they're talking about in franking, it's effectively probably going to halve the benefit of franking going forward, and have a lot of other negative impacts. One thing I thought, in 2019, they went after illogically, they went after the people receiving the franking. Now this time they've decided that they're going after the companies giving the franking. They're trying to stop their ability to give it out. And there's $430 billion on companies' balance sheets. That broadly, if these two proposals that Labor's talking about come out, then that $430 billion is landlocked. And the only way it can come out is companies gear up, and managing or boards won't want to gear up just to pay out fully franked dividends. So broadly, that's lost, and $30 billion a year going forward. We haven't checked our numbers, but it looks like that will be lost in terms of franking. With these current strategies. What I thought is, okay, so they tried to stop people getting franking. Now they're trying to stop companies giving fully franked dividends away. Where else can they look? What other areas can they look for? And what it surprised me that it wasn't. And I know that a number of journalists had written it, but in terms of restricting the size of self-managed super funds, or doing, playing around with super again. So I think that's where they'll, that's probably the next area that they'll go for.
Thanks, Geoff. This next one's from George. He says, given WAM Research is trading at a large premium to NTA, would you take advantage of this to raise more capital at a premium, or would you issue shares at a price equivalent to NTA?
Geez, George, you must have been in our board meeting yesterday. No, that was a topic of conversation. Look, the tough thing is for WAM Research is, it did trade at a discount for a long period of 7 years. So it took us 7 years to get it to trade at NTA. And now it's trading at 40% odd premium. And of course we could have raised capital at any point in time along that way. That strategy is undervalued growth companies with a catalyst. That's half of what WAM Capital does. So in terms of, in our group, if you buy a share in WAM Capital, you're effectively getting undervalued growth companies with a catalyst, and you're getting one share in that, and you're getting one share in trading opportunities, which is WAM Active. If you have one share on WAM Active, one share in WAM Research, is the equivalent of 2 shares in WAM Capital, logically speaking, in terms of how we manage those pools of capital. So, so you might think that WAM Research isn't that large, but then effectively the investing pool is half of WAM Capital when you're talking about another $800 million in that research, undervalued growth companies were the catalyst, and really focusing on medium and small size. So that's about $1 billion, nearly 1.1 billion in that strategy. So we think that's about it. We really don't want to grow it a great deal. So that's why we haven't raised capital. We actually did buybacks in the early days. We did 4 buybacks. We bought back 35% of the company, soon after we floated. My view is buybacks don't work. We should have done a poll on that too. And then we did that over the first 3 years. Then we had another 3.5 years of trading at a discount. And it really wasn't until we'd really communicated with most of our shareholders and they understood what we did. And the ones that didn't like what we did left, and new people came on board, then we got it to trade at NTA or premium. But to answer your question, so the plan is not to raise any capital at this point. I know I'll say that, and something happens tomorrow, but so at this point in time, that was one of Holmes' Court's great. I don't know if enough people were around when he was around. He'd say, "Oh, we have no intention at this point in time," and then at the next minute, there's another point in time. So no, but the plan isn't to raise capital there. And if we did raise capital, probably to answer your question, we wouldn't raise it at NTA. Well, unless it was if we did a rights issue, we could do it at NTA, and then everyone gets the benefit. From our perspective, it's how do we look after shareholders? Because when I floated WAM Capital, we raised $20 million. It was oversubscribed, so we did a placement. We raised $21.5 million, and we started with 2,000 shareholders. Over the first 2 years, we lost 35% of our shareholders sold. Obviously they didn't know why they were there, and they sold out. And then what we realised is the people that were supporting us were our own shareholders. In those first couple of years, we were going to the brokers, communicating with them, and it didn't help us. We were still trading at a 20% odd discount. And once we realised that our current shareholders were the ones, supporting us and buying more shares, then we thought, look, why are we going to the brokers trying to get them to convince people to buy shares? Why don't we just communicate with the people that are already supporting us, our shareholders? So since then, that's really been our focus. And so what we try to do is do the right thing for our shareholders. So that's sort of the plan. And now we've got 130,000 shareholders. So it's worked so far.
Thanks, Geoff. This next one's from Julianne. She says, are you conflicted on these new changes that Labor's proposed? And how does this impact your LICs?
Yeah, to me, this is the great thing. Is someone asked me this question yesterday. They said, "Oh, those budget changes, they must have an impact on you." Personally, I'm on the highest tax rate. I'm on 48 and whatever it is % personally. So if I get a fully franked dividend, 30%'s been paid. So I've got to pay a top-up tax of 18%. So it's not in my interest. Secondly, with those buybacks, and this is the interesting thing is they're all talking about, and the journos, they like talking about, the super funds have made this happen or made that happen. To me, I think that's a bit of a smokescreen, because effectively Wilson Asset Management, we manage $5 billion. Now I know we haven't got a super fund in there, but we don't participate in the fully franked buybacks, because why go for a lower price? I know there's franking there, but we want the higher price. If we make profit and we pay tax and we get enough franking from the companies we own, so we didn't need to soup up our franking. So to me, I would have thought it's the mums and dads. They're the people impacted. It's the retirees, the self-managed super funds. They're the ones. what I just get incredibly frustrated. What frustrates me is back in 2019 when Labor came out with that illogical strategy. Then it was just they didn't realise the carnage and the impact that would have on like ordinary Australians' lives. They eventually did. Everyone's trying to say, oh, look, it's the institutions, they get the benefit, et cetera, et cetera. If I was managing money as an institution, why would I? And my performance is, I don't get graded on my after-tax, my fully franked after-tax performance. I get graded on all the super funds. I get graded on the performance of the capital that I get. The fact that some of it's fully franked is just a benefit. So it has zero impact on us. What it'll have, it have an impact on a significant number of our shareholders. Negative impact. People that have done the right thing for the last 20, 30 years, worked hard, got their self-managed super fund, not relied on government, and it'll have an impact on them. It'll have an impact on corporate Australia, employment. You look at BHP, have used these buybacks. They've got the ability. They've got significant franking credits and Rio on their balance sheets. They could pay out, $8, $9, $10 billion fully franked. So will BHP need to pay any more tax in Australia? Of course not. What they'll do is they'll invest offshore. I mean, to me, it's as Jesse Hamilton, our CFO, put it so well the other day when we're talking about it. He said, what's happened is, the Labor government has, say we're in a house. The Labor government's gone off and gone to the fuse box and turned some fuses off. The only problem is they didn't understand the grid of the house and where the electricity ran. And they won't understand the consequences. They don't. All they're doing is listening to Treasury, and that's why I quoted in my little speech today. Like Paul Keating said, he called it out. The Treasury will be trying to stop the franking system. And unfortunately, Labor hasn't been strong enough. And Treasury has convinced Labor to do these things. And unfortunately, it's the start. And that's why we've just got to work. We've got to work as hard and fight as hard as we can to just stop it. That's what we've got to do. Sorry, I'm ranting a little bit now.
That's good, Geoff. Next question is from BS. And they say, if a LIC trades consistently below NTA, then wouldn't it make sense to simply liquidate the holdings and return the assets to shareholders? Do we see this happening often? And if not, why not?
Yeah, it does happen. And that's the logical thing. Well, you think it's a logical thing. The tough thing is, and I've been around, I suppose we've all been around a little bit. I can't say my grey hair, but my lack of hair. And we've seen it before. The tough thing is you tend to find people, when things are the worst, that's when you want to be buying. Like to me, say a company's trading at a big discount to NTA, and I saw it with Australian Infrastructure Fund. Really, Australia, years ago, there was this great company called Australian Infrastructure Fund. It owned the best assets in Australia. Percentages of various airports. It was trading at a big discount. I think around the time of the GFC, things were tough. A few hedge funds got on the share register. They gave them a hard time. And the people managing it didn't want the stress and weren't prepared to fight for the shareholders. This is the board. And so they sold the assets to the Future Fund, which they would have just made a phenomenal profit on it over the years. And they gave the capital back to shareholders. They actually did exactly what they shouldn't be doing. So the tough thing is most people want you to liquidate at the bottom of markets, when the discounts are biggest. And that's actually when other shareholders should be buying. Anyway, that's...
Thanks, Geoff. And I think that's about all we have time for today. So I'll pass back to you for closing remarks.
Look, again, thank you very much for your support. And I can't take my hat off to the ASA more than you guys. You're really standing up, for shareholders. And to me, the work you do is exceptional. We are proud to be associated with yourselves in terms of being able to present today. And to me, we've really just got to stand up for what we believe is right. And we believe what's happening at the moment in terms of the government is not right. So we'll be with you all the way. Thank you.